Hello, welcome to AleaSoft webinar. My name is Alejandro Delgado, Associate Partner of AleaSoft, and thank you for joining us today to this webinar with the topic Prospects for the Energy Markets in Europe, Keys to Maximize Profitability and Efficiency of Batteries. Our first speaker today will be Oriol Saltó, Associate Partner of AleaSoft, that will analyze the evolution and prospects of the European energy markets. Then, we are sharing this session with Javiera Diego, CEO and co-founder of 7C Energy, that will talk about the importance of demand and secondary demand forecasts, the analysis of benefits according to the degree of battery use, the financial optimization of batteries, and the regulatory issues of storage, subsidies, and capacity payments. If you have any questions at any time during the webinar, please use the Q&A menu, and we will answer them after the presentations. And now, I hope you enjoyed the webinar. Oriol, please, you can start now.
Thank you, Alejandro. Good morning, everybody. Very happy to be here again, 5 weeks, I think, after our last webinar in April. It was soon in April. Now it's kind of in the second part of May. Very happy to be here with Javier today, talking about batteries, a very hot topic. And I've had the chance to have a glance at his slides, and it's going to be very, very interesting if you are thinking about batteries, if you ever considering investing in batteries, going to be very, very, very interesting. So on my side, we are going to, in this first part, we are going to talk about energy markets, take a look on how they have been during the last weeks compared to what we saw in our last webinar. In our last webinar, if you remember, we basically were saying that everything was down, the sentiment of the market was kind of downwards. It's changed. It's changed. I mean, prices are recovering. Most of the markets prices have rebounded, but I mean, they are not very exciting, but the sentiment is shifting. So interesting things. We will see interesting things. So a few words about AleaSoft and the services that we provide, in case you don't know us. So in AleaSoft, we are we are energy markets advisors. We have more than 25 years of experience in the sector, and we offer forecasting reports and forecasting and energy markets consultancy with basically for any energy market at the global level. We cover all the energy markets, gas and electricity, CO2 in Europe, and we also cover some markets in the Middle East, South America, North America. And we basically have data, and we are ready to provide services basically in any energy market all around the world. The forecasting methodology and the modelizing methodology that we use is a methodology that we developed ourselves specifically for forecasting in the energy sector. The 3 main points that we always like to stress is that it is a completely scientifically based methodology. It's a hybrid model that combines statistical techniques more from the statistical classic, let's say regression, time series analysis, econometrics, etc., combined with more advanced technologies from the artificial intelligence, so machine learning algorithms, recurrent neural networks, and this hybridization of the methodologies gives a very strong and robust results. The consistency on our forecast that keep coherency on every delivery. It's one of the main aspects that our clients trust the most. With these clients, we have had a relationship of more than 25 years, 26 years. This year we are celebrating in the company. We started in the Iberian electricity market. Now we are covering basically all the markets at the global level. We provide a wide range of services. We basically, with all these services, we can cover all the needs from every player in any Asian in the energy market. So from producers to consumers to grid operators, investors, traders, sponsors, investment funds, utilities. I mean, basically, and it's all of these players at some point they will need some of our services. our services that basically we have a long-term forecast for prices, demand, renewable energies, short and mid-term forecast. That goes from the hour ahead, from day ahead, 10 days ahead, and mid-term that we say it's more or less 3, 4, 5 years ahead. Energy Alea storage covering all the services for energy storage facilities, batteries mainly, but also hydro pump stations. So basically, forecasting revenues at the long term, preparing financial models. So a wide range of services for storage facilities. We have a couple of marketplaces for PPAs and for renewable projects. So among our clients, we can match, we can try to find the match for a PPA and off-taker, etc., or for a buyer or a seller of renewable projects. We provide weekly reviews of energy markets, monthly reviews, yearly reviews, quarterly reviews that we regularly publish in our website. We also make these webinars at least once a month. And then we have a strategic consulting, but basically any needs, any decision that you have to make, we provide the data, we provide the analysis, we provide the modelizing. So you take responsible and informed decisions. You make informed decisions. So let's just start with the fuel market. We always start with Brent oil. So basically, it's been kind of interesting lately. If you remember, in our last webinar, we were basically just after what was called Liberation Day. So when all this trade war began, so basically the outlook for the global economy just shifted completely to a very pessimistic view. Since then, prices have been moving basically responding to news about this trade war and also about the oil production, the oil supply mainly by OPEC Plus. So basically, prices have been going from the $65 to the $60 per barrel. This is the lowest that we have had so far this year and in several years. Basically, this is the new minimum that we have seen since then. Since April 2nd, it's a 20% loss in prices, now recovered back to this level of 65. Right now, it's trading at 64.2, so still at this level. So basically, what has happened since last time? We had at least a temporary agreement on these trade relations between US and China. This changed a little bit the sentiment about how the global economy is going to evolve. So prices went up a little bit. Also, OPEC Plus, as they already announced, increased their production twice during this period. And this morning I read news that they are planning to increase the production again in July. So this obviously is putting downwards pressure in prices. And then also we have had some starting talking between Iran and US regarding their nuclear energy program. So there is some potential lifting on the sanctions, the current sanctions on Iran. This means that maybe at some point Iran oil can also enter into the market. This is more supply, so this also puts downwards pressure. What can we expect on the coming weeks? Let's see. Basically driven by geopolitical developments. On one side, as we mentioned, Iran-US negotiations regarding nuclear energy. And on the other side, also, Israel is kind of targeting or at least talking about new tensions with Iran. This obviously puts also some pressure on prices. And on the other hand, it looks like as prices had went down quite a lot, then some, let's say, speculative buying is also taking place. So basically avoiding prices going down lower than what we have seen so far. So we will see in the coming weeks. Basically, depending on what are the news on the global geopolitics, prices will go. It looks like it's difficult that they will go below 60, and also difficult that they will recover at the previous levels that we had at the beginning of the years. Oops, sorry. Going to the gas prices. Looking at the gas storage, this is usually something that I show afterwards the price, but it helps explaining the price behavior. So I thought it's better to start with the levels of gas storage. So right now at 45%, so we are refilling as expected. The refilling rate the pace is going as expected, similar to previous years. The problem is that we are quite low respect to previous years, but we are in the right place. An important event in these last weeks is that the target that the European Union has had in order to how much the reserve has to be refilled before the winter. That previously the level was 90% by November 1st. Last year we reached that level month before that target. This year it's going to be difficult. So they basically softened that target. Now it's down to 83%, and it can be reached anywhere between October 1st and December 1st. And even if the market conditions are unfavorable, then this limit went down to 79%. In any situation, the European Commission it's trying to assure that before winter we are going to have at least 75% of the gas storage filled. We are at the correct rate to get to these levels. So it looks like it's going to be at least from the refilling side quite easy, let's say, if the market conditions do not worsen a lot. Gas prices. So since the highest price that we had at the beginning of February, we saw in our last webinar how prices decreased a lot, basically due to the decreasing of oil prices, all the trade war, and all the pessimistic view on the global economy. Prices went slightly downwards. I think they reached 33, and they have increased it a little bit during the last days. So basically, because as we expected, this was kind of a decrease in prices, really not following the fundamentals. So right now that all the trade war heat has slightly passed a little bit, we are going back to the fundamentals. We are going to need a lot of gas to refill our reserves. Prices so we are going to need a lot of gas. This gas is going to come from the LNG market, the global market. LNG demand from Asia is growing as expected. So we will have to compete for that gas. We will have to pay a little premium in order to get those cargoes come to Europe. So as we expected, prices recovering a little bit. So during the summer, if everything goes as expected and there are no major news on new geopolitical events, prices during the summer should be around 40. Difficult to reach up to 50, but we will see. So we expect a slightly increasing prices as we enter into the summer, into the mid of the refilling season. So CO2 market. This is always the market that is more or less going with the gas prices. Now it's taking some character because in our last webinar we were just at the lowest point. Prices have recovered at 21% since then. So a huge, I would say a huge increase because if we compare with gas prices, which were usually correlated. So the CO2 market is outperforming gas prices right now. So basically, why this increase? Well, several reasons. One, because we were at very low prices, so prices were more. There were more upside risk than downside risk, and basically increasing demand, because now we will have another emission market that will include emission from transport and buildings. So this is basically an expected increasing the demand. Also, all the investment funds that trying to speculate a little bit, let's say, with this market, they are again having a net long position, so they start selling once the prices start decreasing. So the net position went close to zero. Now they are long again, so they are again buying and expecting the prices to increase. And then there have been UK a summit between the UK and the European Union, and one of the topics was were the carbon prices, carbon markets, because right now carbon prices in the UK are lower than the EU. This means that they were kind of susceptible of having that carbon border adjustment mechanism. So one of the agreements were that they will try to make these two markets closer, more de-harmonize the carbon pricing. So basically having closer prices. This will mean that UK will have to have limits on supply of these allowances as strict, at least, as the ones that the EU have. And basically they will try to make both markets or both systems similar enough so that the prices will converge. That's the idea. That's also one of the factors that is making price increase, mainly in the UK. So now let's move to electricity markets. I always take this opportunity to show one of the services that we offer to our clients, that is an online database that has all the data, all the information, all the variables related to the energy markets. So anyone having something to have with the energy markets needs information, being it analysts, traders, investors, journalists, CEOs. So anyone related with energy markets needs information. Information is power, and I would say in the energy sector this is even more important. And here what we are seeing are the monthly average prices for some of the most important electricity markets in Europe. And the last full month that we have is April. Exactly, it's April. And basically compared to what we saw in our last webinar, that was March, prices have been decreasing. All markets prices decreased. So the one that decreased the most are Spain and France. Spain by 50%, France 45%, but and the rest more or less around 15-17%. That's the average. Italy still having the highest prices, and again Spain having the lowest prices, then France, and then the rest more or less at the same level. If we take a closer look at what happened last week, so those are the daily average since the beginning of March, and basically we see how the prices have been following. First the decreasing gas prices, now the slightly increase, also decreasing prices due to less demand during the spring, more renewable output, mainly solar and photovoltaics. So, and here what we can already see is the lowest prices that we are seeing from Spain are the blue ones, and France very close, the red ones. So the rest of the markets, average prices around 80 euros megawatt hour. Spain and France are having prices as low as 20 or 10 euros megawatt hour on average per day. If we take a closer look to the hourly prices, so those are the hourly prices since the beginning of April, and we are see how peak hours are close to 150 to even 200 euros megawatt hour, average prices around 100 euros megawatt hour, and then in solar hours, that are those low prices that we are seeing here, prices close to zero or even negative, and some episodes with very negative prices. So it's the typical behavior that we have seen every spring, very low prices during solar hours, and that makes the average daily prices also quite low. If we take a closer look at the Spanish prices and Iberian prices, so Spain and Portugal, and usually both markets are highly coupled. So we just usually most of the time, up to 95-97% of the time, prices are exactly the same because there's a lot of interconnection capacity between the two countries. But here something happened on April 28th. We had that blackout in the whole peninsula, Iberian Peninsula, and since then the interconnections have been interrupted. Most of the interconnections. So Portugal is no longer importing, at least at the beginning. Now it's again letting some imports to come, but Portugal is not importing as much energy as they could from Spain. This means that now that the interconnections are rapidly saturated, that the markets are split, and this is a kind of a good example of what happened when you have let's say infinite interconnection capacity among markets and when you don't have. So since then, prices from Portugal have been clearly higher than the ones in Spain, because Spain have a lot of renewable energy production that cannot be exported to Portugal. Then this market is splitting and resulting higher prices in Portugal. So if we take a look at the spring situation of prices in Spain, those are the hourly prices for Spain since February until today. Basically, around mid-March, we started having recurrent and periodic and consistent very low prices, zero prices, even negative prices during solar hours. This is something that we also saw last year. So if we take the same time range for the last year, this is the same period, but for 2024. And in that case, it was around mid-February that we already started having zero prices. And we had consistently lower prices. So we would say this year we are a little better. And by the end of April, the situation started recovering. And then by the end of May, I would say we were basically kind of recovered, even if we go slightly lower. So already in June, prices went back to more a different situation, more let's say the summer situation, that it's quite different from the spring situation. So basically this year we are slightly better, I would say, and we started having such a situation of negative and lower prices later. So probably this was due to mainly weather conditions. So probably this year we are going to recover, let's say, from this situation slightly later than we did last year. So similar situation, I would say slightly better this year, and probably we shifted everything a couple of weeks or 4 weeks. So probably we will start recovering by the end of the month, maybe June, mid-June. I would say we will enter in the summer situation. That is a different situation. Okay, let's go back to the slides. Just to illustrate this, those are the number of hours with zero or negative prices every year until May 22nd. So each year until May 22nd. And so if we compare 2025 with 2024, as I said, we are slightly better, but probably because we are just going late compared to previous year. And in the rest of the countries, also more or less in the same situation in last year. So we will see at some point. If we will see by the next webinar in June, if we are already in the summer situation, in summer conditions, or we are still in a spring price condition. So let's take a look at the forward curve from the futures market. So what are the markets telling us about the energy that's going to be delivered into the future? Basically, following spot prices, the future curves for the Brent oil slightly increases mainly in the short term, around 4%, basically following the increase in the spot prices, no changes at the long term. Gas forward curves, as prices have been increasing, spot prices has been increasing, also did the futures, 1.3% increase for the prices for the summer. And then for the next 2-3 years, quite notable increases, so around 4-5% for the following seasons, up to, I would say, up to 2027. So we are seeing how these increases are having a repercussion down the horizon. CO2 forward curve, as always, very rigid. As spot prices increased, all the forward curve increased 16%, following the 21% increase in the spot markets, spot prices that we saw. Futures for the electricity, again, following the trend of the gas futures, increases in all the markets. Germany, the main one. Italy 8%, Spain 5%. France is the only one where prices decreased by 2%, but it was only for Cal 26. Beyond Cal 29, prices increased in the rest of years. Notably, how all the forward curve increased in Italy, 9% at the long term increase in just 5 weeks. So this is just a reminder that we always say those are just forward curve. Those are futures market, are quite illiquid at the long term. So they are not suitable for market price as market price forecast. They are just an indicator on how the feeling is today, or what is the energy that we are paying today for the energy that is going to be delivered. Obviously, it has some relation on the expected prices, but they are not a good price forecast as we understand what a price forecast should be. So just finishing, summarizing the key elements, what we are taking into account now when making forecast. Oil prices now at the level of $65-$60 per barrel, depending on the geopolitical news in the coming days. Also, if OPEC Plus is again raising the supply, all this is going to play a role in prices. Gas prices rebounding as we are approaching the summer. Again, LNG competition at the global level, it's going to be intense, let's say. So expect prices to keep raising at least for some more weeks into the summer. CO2 market has kind of rebounded, very, very interesting, I would say. So it's gaining some interest because of new demand, because the new linkage with the UK emission market. So interesting move in the CO market. Electricity markets are still in the spring condition, and we will see how we enter. It will depend on weather conditions mainly. When we enter the summer condition with more demand, so meaning higher prices, also with higher gas prices, we should expect higher electricity prices during the winter. And as always, at the midterm, we are entering this next 5 years in the decade, in the century. So basically, this is now as we last 5 years, we were talking basically about solar photovoltaics. It was the main topic. Now the main topic for the next 5 years at least is going to be energy storage, batteries. That is the main topic on this webinar, and more at the long term than renewable energies, all the new demand for renewable energy, green hydrogen production, the hybridization of all these technologies with battery storage. This is what it's going to shape the market prices at the long term. And just to finish, to remember all our services for battery energy storage system. We have services regarding the long term, so revenue forecasting for BESS at the long term based on our long term forecast from Alea Green, and for BESS operation and optimization at the short term based on our short term forecast for Alea Blue on how can you operate your battery at the short term. And we do all kinds of projects. We've done standalone BESS hybridized with wind, with solar, and even with solar and wind. So we do all kinds of projects. And just as my last point, invite you already to our next webinar. It's going to be June the 12th. And we are going to be again with Engie. Always very interesting, the webinars with Engie, talking about the markets, the opportunities, the PPAs markets. Very interesting news and information about the world of the PPAs. Very interesting. So that's all. Thank you, Alejandro.
Thank you very much, Oriol, for that interesting presentation. And Javier, thank you again for joining us today. When you're ready, you can change your slides.
Yep. Hi, thanks, Alejandro. I'm ready. Let me share the screen.
Perfect.
It's all right. Okay. Well, thanks all for your attendance. Thanks to AleaSoft for inviting us to the webinar. We are thrilled to be here, and we got a challenge from AleaSoft for the webinar because we were told to present something quite new or focus on not the mainstream topic. So, well, before that, a brief introduction of our company. We are a Spanish platform focus on the Iberian market, and our key focus is the development, construction, and operation of storage in Spain. Of course, we are more focused on development right now because this is a quite new market. But we are, and we have been since a year, developing also the operational model of the batteries. This is key for us. We don't want just to be developers. We are our intention or the view is that the value is going to be on the operation of the batteries, and this is what we have focused on. We are also obviously trying to accelerate our entrance in the market. So we are also considering acquiring projects from third parties that are under development. But yeah, today we are going to focus on, or we are going to show you one analysis that for us is key. I think the mainstream topic in the industry is the price forecast, and that is obviously very relevant. But I think there's some inertia from the past. We are used to just build a solar project and wait 25 years until the warranties elapse and the project is done, and we are just producing energy. So it's relevant to have price projection. But batteries, at least in our perspective, because we are more focused on merchant operation, batteries is a totally different business. So long term is not so relevant, and the maximization of the spread you make every time you do a cycle is obviously important. You shouldn't be losing money anytime you charge and discharge your battery. But there's also the usage factor, and that is the focus of the analysis. We just made a lab case. Obviously, we are not including, or we are including a projection on our model, but we are not going to be talking about that, and it's the same for each case. So we wanted to compare apples to apples, and yeah, let me walk you through that. So this is mainly the base of the analysis. We have carried out a simulation of a 25 megawatt project with 4 hours of storage. And the base we have used is this matrix for prices together with some ancillary services that are not reflected in this table. But I mean, this is the average price of year 23 and 24. January to February and the 24 hours of the day. So this is the base, and this is where the model starts. After that, the model is going to be running on an hourly basis a program of operation of the plant. That is what we are changing. This is the main input we are going to be changing. So we are using the same matrix, giving orders to the battery. The green means that we tell the battery to charge if available. So as we have a 4-hour project, it will start, in this case, would start charging at 3 o'clock in the morning, and then keep charging until it gets completely full, taking into account all the round trip efficiencies, all the efficiency of the battery. Every year it's going to be more degraded, so it's going to be slower charging. So, but this is what we are moving. And again, we are modeling, fully modeling on an hourly basis a 25 megawatt project with 4 hours of storage, and we are monitoring the revenue, the capture margin, and obviously we are calculating every hour the degradation of the battery to get the state of health and stop the simulation when the battery reaches 60% state of health, which is, let's say, the industry standard on how long the battery can last, or when the warranties of the projects go away, and you should be changing that. We are not including any OPEX in the analysis because that would make things more difficult and less obvious, and then also includes a lot of uncertainties and changes, and can distract us from the core results of the analysis, which is really using the net present value calculation and discounting the revenue generated by the battery in each scenario of operation by, in this case, 10%. I think there could be some debate here. We have chosen to apply the same rate to all the cases, but as you will see, obviously a more aggressive operation of the project shortens the lifespan of the batteries, and maybe a lower discount rate should be used because there's less risk exposure to long-term forecast. But we have decided to apply the same discount rate for all the scenarios. So based on this methodology, we have run 3 scenarios. Again, prices are fixed. It's the same curve for everybody. Assuming what we saw, the day ahead market prices and how they are spread all over the hours on an average base. Ancillary services are the same for all the projects, for all the simulations, and we have modeled 3 cases. There were more to model, and I think there's a 4th one that we can discuss later when we see the results. But we have modeled 1 case in which the batteries will be charging in the more obvious moments based on the day ahead market, which is using the valley that we usually have in Spain at night on prices, and then profit from the small peak that we have in the morning. And then also using, obviously, the valley that we have all over the day. Actually, as Oriol mentioned, right now we even have negative prices, so we would be paid for charging the batteries, which is great for our case. And then discharging in the peak at night. That's the first one. So that's let's say, the most optimal. It's not the most optimal in terms of maximizing spread, but it's the one that gets you the highest spread captured in the simulations. The second one is similar, but we just included a couple of hours in which we are going to be charging the batteries at midnight and 1 o'clock in the morning, and then discharge them also at night. This obviously is going to reduce the spread because it's not optimal in terms of day ahead market. There are still some ancillary services in Spain that could make some sense, but obviously this case is increasing the use of batteries, and it's obvious that as it is considered is reducing the spread captured by the battery, so wouldn't be so optimal. And then we have even modeled the continuous usage, which is really randomly tell the battery to charge and discharge every hour and see what you get. The reduction of spread is going to be obvious. And well, but I think it's good to show an extreme. I had a doubt about either showing this case 3 as one extreme or the, let's call it case 4, which would be just charging the battery in the morning when the prices are 0 and just discharging it when the peak comes in the evening. But you would be surprised. The results are not so different. But yeah, let's move to the results of those analyses. So in case 1, evident trading, what we got is that the batteries could operate for 18 years, just doing a couple of cycles, around 1.5 cycles every day, and the use is low. And as we were expecting, the capture spread on year 1 was 7.3 euros per megawatt hour. Then the rest of the years, we just added the same inflation and let the curves grow based on that for the analysis. No major changes on that. Case 2, we obviously lost almost 3 years of usage of batteries, and the capture spread was 64 euros per megawatt because, again, the additional usage of the battery during night gives you some revenue, but obviously less than what you were expecting. And I'm sure I haven't looked at the hourly results of every hour, but I guess we are going to also be losing money in some cases. And then we have the continuous usage, which, again, I mean, it's a 4-hour battery, so it never gets charged or discharged. Never gets discharged fully, but I mean, the project can operate for 10 years. Net present value is really lower, and the capture price, again, is irrelevant. It's 43 euros per megawatt hour, which is really low because, again, we were expecting that is you just use the battery as nobody would. But I mean, this take us to the results and the comparison, and I think this is the key point for us. Again, we are showing the differences on spread capture in each case, and as you would see, I mean, from case 1 to case 2, there's a 12% lower spread capture by the batteries, which is quite relevant. But the relation with the net present value and as it takes into account also how present, it takes into account the time effect on the return of the project, is not so impacted. It's 3.5% only. So this was quite shocking for us in the past, but that made us start to consider other factors. And again, losing a little bit the focus on maximizing spread and focus on a more optimal operation that takes into account also the time effect on the investment. I mean, this is very important, and here we are gonna come a little bit into detail on how Spain works in terms of market. But if you want to optimize your battery, you need to follow the scheduling mechanism that we have. So we have a Red Eléctrica has a very detailed timetable on what you have to offer every day before the day zero starts. So in Spain, we close the day ahead market at 1 p.m. But then an operator of a project needs to schedule also and offer the different ancillary services also the day ahead. So this is where I think a very important product comes into play, because it's easy to schedule your battery for the day ahead market, but then once you need some type of forecast on which is going to be the volume of and the direction of the ancillary services the next day, because especially in Spain, the fast frequency response market is offered also the day before. You need to schedule your battery to be available for charging or discharging at specific hours for that service, with 4 hours of difference between 4 hours before the day ahead ends. So the more you have visibility on what is going to be the direction and the volume of the different ancillary services markets for the next day, the more you are going to be able to schedule your battery to operate on those markets. And again, spread is important, but also the volume of megawatts you move every day is going to have a huge impact on the return of the project. That's why I think it's mainstream to look at the different prices, projections, and the volume, but of the ancillary services markets and the cannibalization of storage in the future. But really, I mean, given this analysis, one of our main focus, and I think should be the main focus for anybody that is considering operating the batteries on a real-time basis, not with a tolling agreement. Maximizing the use is also very important, because I mean, when when you sacrifice 10% of spread capture, but still you have the same return, that gives a lot of I mean, that makes your that reduces a lot the risk of your investment in the long term, and that's key for us. I think this is a topic that the sector should be also discussing more, because again, I think there's some inertia on the investment community on how to look at the storage projects. But I think we need to change our mindset and start understanding that maybe the battery is not an infrastructure project, it's just a consumable item that you may use for 5 years, or try to use it to make it last 5 years, provide some type of services on the grid, more than just moving energy from one hour to another. There are technologies for that, but maximizing the use of storage is really key for harvesting the most of the profitability of the project. So again, we are focused on that. We are working closely with AleaSoft also on making sure that we get as much visibility as possible on the ancillary services volume for the day ahead. That's key on our base case, and that's a boost on return. And I guess I'll leave the floor for questions, because I have already got to my time. But well, thanks for being with us, and again, happy to address any question. Just to close, because I mentioned that there was the case in which we would just charge the morning or at noon and then discharge in the peak time. The net present value of that case was 3 million higher than the worst case we have shown here, using the battery with charging and discharging all the time on a random basis. so really low compared to case one. And the capture price was 90 euros, something like that. So we had the highest capture price, but the lack of use of the battery really impacts a lot the return, and the net present value was really low compared to case one. So again, I mean, I think we should be discussing also, and there are many, I mean, after the blackout in Spain, there are many conversations, many debates in many forums. I think I mean, making it clear how the batteries can operate in the ancillary services, and maybe make a little bit easier to predict these volumes, and to allow for maximizing the use of the battery, would also help to reduce the cost of the ancillary services right now in Spain. And that would be a benefit for customers, that would be a benefit for the system, because really a battery operator can make the same return using the battery, lowering the price of the cycle every time. So I think that should be an important point, and a key element of the debate that is now going on in Spain.
So thank you very much, Javier. Really interesting information, great presentation, and thank you again for sharing the webinar with us and all of that interesting data. So we will start now the Q&A section of the webinar. A lot of questions are already. Oriol, I see you have already selected some of the questions.
Yes, yes, a lot of questions, very interesting questions. I would say most of them are for Javier, so I'll let the space to him. But let me answer some of the questions. Just a couple of technical questions, just to start. Forward prices are M+1. So yes, when we are talking about forward prices for Brent, TTF gas, and CO2, in the graphics that we show at the beginning of the webinar, we are talking about front month. So front month is the first available future. In Brent is M+2, in TTF gas is M+1, and in CO2 I think it's M+1 also. So yes, it's the front month, the first available future that you have. And then may I ask, where do you take the electricity prices from? What is your source? Well, electricity market prices are published by the operators. Each operator has its own web, its own system, its own format, its own way to show prices. So I would say a good tool, it's our online database, where you have all the prices always updated, always all in the same place, and always ready to be analyzed, all in the same format, very easy to access. So that, I mean, there's a lot of public information for the energy sector, but it's spread among a lot of different sites, a lot of different formats, ways to update. So that's the value of having a centralized online database. Then less technical questions regarding prices and what we show. So about batteries, how does the degree of battery utilization influence the annual revenue at the long-term degradation of the battery? So yeah, as Javier mentioned, degradation of the battery due to utilization, it's one of the factors that impacts obviously the revenue and how much you can get and how long you can operate the battery. Also, there's why also most of the long-term projects also include at some point in the midterm of the lifespan revamping or repowering or increasing, adding some batteries or replacing existing batteries in order to recover at least some of the original capacity that you lost over time. So yeah, so basically batteries degrade their available storage capacity in two ways. So they degrade just due to time. So we call it calendar degradation because it happens regardless how you use the battery. And this can be something between 0.7% to 1% each year. So you lose this capacity regardless you use the battery or not. You know that because most of our phones. If you take a very old phone, even if you haven't used it for years, its battery storage degraded, and then it degrades due to its usage, 0.001 more or less % of each full cycle. So each time you use 100% of all the capacity of the battery. That's also why usually not all the capacity is used in each cycle. So the depth of discharge, usually it's 95%. So you never fully charge or fully discharge your battery in order to also to preserve some of this degradation. So, but as I mentioned, as the battery degrades, even if you use it or not, usually the advice is use the battery as much as you can within some rational limits. Use it as much as you can, because even if you are not using it, you are going to lose some of the capacity. So that's also why it's interesting to have, as Javier was mentioning, using at least 2 cycles per day whenever possible, because your price spread is going to be lower, but you are going to use it more. So at the end, the revenue will be higher, and you will degrade it slightly faster, but at the long term, it's much better to use it as much as you can within some limits at the beginning. Also, because ancillary services ancillary services prices are going to be cannibalized by the battery storage. So as more that you can use it at the beginning, usually the better. And now I'll let Javier answer some of all the questions that he has.
Yeah, I guess we have a hard stop at 11, or well, you let me know when I should stop, because there are questions coming all the time. So I'm gonna go quickly as much as we can. So for ancillary services, we have considered also the tertiary market, which is a market in Spain that is really spot. We are not including the fast frequency response in this analysis, especially because I mean, it has some risks. I mean, if you commit to provide a service to discharge your battery, and the system operator calls you, and at that time your battery is not charged because the ancillary services went other way before the period you are called to discharge your battery, you can get heavily penalized. And I mean, we should get into the detail on how the fast frequency response market operates in Spain, but basically you offer your power available, but you don't know what is going to be the energy that is going to be used when the time comes. So it's a really volatile market and difficult to predict. So we have used the tertiary market, assuming that every year happens the same, more or less. And if it makes sense, you go to that market spot on real time. If not, you don't. We try to make it simple, but obviously the analysis should take into account the fast frequency response market. And again, I mean, we just made a very simple, well, let's call it the tip of the iceberg analysis on what is the impact on what is the benefit of using more your batteries. And again, going back to the results, is like you will get almost the same net present value with a more aggressive use than you get with a more conservative one, even if the capture price is like 10% lower. So I would leave it there. But again, we just use the tertiary market for ancillary services. There's also a question about why we didn't include the perfect trading. I think it's already answered. I mean, if you really include all the ancillary services that we have in Spain on the forecast, you can do the perfect trading doing a regression. But I mean, by definition, the ancillary services and the energy used for ancillary services is really the energy that nobody could predict that would be needed. So it's going to be impossible to do the perfect trading because not even the system operator knows what is going to be the real volume of energy of each market every day. So, I mean, we made this just one cycle, maximizing the capture price operating in the day ahead market, but I think it wasn't relevant for the webinar. It made more sense to focus on the small differences when you really start maximizing the use of the batteries, and what just adding a half of cycle more made us difference between capture price and the net present value. The spread and how we calculated that, and we don't assume it's true. I mean, there's a question about a couple of things about the methodology of the analysis, and so the spread we have estimated is a fixed spread. It's a fixed set of price. What we are moving is when we turn on and off the battery. That's it. So again, we took the real average prices of the Spanish market in 2024 per hour. We took the real activations of the tertiary market in Spain in 2024. And then we just inflated those values a little bit. I think it was 1% or something like that. But we are not assuming changes on that. I think if we added that, then we get into which is the view of each market advisor on how the prices are going to go, and it changes. You should be making a lot of analysis with different curves and see what is the best strategy for each market projection on the long term. So we have not included also the OPEX. I mentioned that, and I think it's a good point, because I mean, the more again, this is the tip of the iceberg, but if you take into account the OPEX, obviously if you have a shorter time of use of the batteries, maybe you could be saving some money, maybe in warranties extension, for instance. But I'll give you more points we have not included, but should be taken into account. In case 3, we are charging and discharging the battery all the time, just 1 hour with an hour difference. It doesn't make sense to have a 4-hour battery for that. But again, we wanted to compare apples to apples. But I'm pretty sure that if you this case, and we will do it, and we have done it already, but if you design your project with a 2-hour storage, you reduce a lot the capex, and the revenue is going to be the same. Maybe the degradation is going to be higher, the lifespan of the project or the battery is going to go low. Maybe you move to 6-7 years, but I think the return in terms of IRR, non-net present value, is going to be higher. Okay, again, a couple of clarifications. The capture spread is the difference between how much you pay for charging your battery and how much you get paid for discharging your battery each cycle. And the years criteria is when the battery reaches 60% state of health in the different scenarios. So again, low use, long lifespan, harder use, shorter lifespan. I think I'm going through the questions because I don't want to.
Yeah, you can answer a couple more, and
okay.
You can enter.
Yeah. There's a good one, intraday market. There's a question about why we are not considering the intraday market. I mean, in our operational model, we are considering it, but we don't. I mean, the way Spain works, intraday market for us is like how we to go to the poker terminology, is like a joker for us. We don't consider operating in the intraday market as a base for our batteries. We take the intraday market as a card we can use if the schedule we planned on the volumes and the flow of energy during the day is not going as we were expecting. Intraday market in Spain is good for, I mean, if you were considering that after the whole night operating in the ancillary services market, your battery would be charged at 75%, for instance, and you end up the night and the battery is charged at 90%. It's a good moment to go to the intraday market, sell some energy and reestablish the state of charge of your battery. That's the way we use it in our operating model. Obviously in this webinar, we have not included that. Again, we focus just on day ahead market that has no deviations or no foreseen deviations, and also just an ancillary services that is called on a spot basis, and so you don't make any mistake. I mean, if it's called, you put the price. If the price is lower than the marginal price, you are discharging or charging your battery according to the volume you have offered. So we have not included more uncertainty, but again, I mean, we are not basing the operational model on the intraday market. We use it as a way to correct deviations based on the projection made the day ahead and what happens on real time. I think, let me look if there's. Yeah, just the last one, I think, by Luke on the battery behavior back tested against real life. I think this is important. I mean, we have spent some time discussing with different manufacturers. We have a quite good knowledge on what the manufacturers can offer in terms of degradation based on use, and that is embedded in the calculations. I mean, again, we are focused on developing and owning in the future operating projects in Spain. So this is key for us, and we have a good database on battery behavior. And our model is including those factors. I won't say the manufacturer we have used for this case, but yeah, everything. I mean, in this analysis, we have been very generalistic on prices. We have been, well, that was an input, but the other input, which is how the battery behaves, is really modeled in detail, based on the actual performance of a battery from a manufacturer. So when we use it more, it degrades more, and again, the simulation is run on an hourly basis. So it's quite granular in how the battery gets degraded, and that is taken into account very thoroughly in the net present value analysis we just made.
Okay, perfect. Thank you, Javier, for your answers. We will answer the remaining questions directly by email. And as Oriol mentioned, I invite you to register to our next webinar. It's in June, and we will be sharing it with Angie again. So thank you again, Oriol and Javier, for your presentations, and the audience for joining. Have a nice day.
Thank you. Goodbye.
Thank you. Bye.